All right, we'll just give it a minute while people fill in here, and then we'll go ahead and get started. All right, being joining now. I'll give it another minute. All right, I'm sure people will continue to join as we get started here. Steve, I know you have a lot to cover, so I'd like to go ahead and welcome everyone. Good afternoon and a warm welcome to our special edition financial services webinar today. I'm excited to welcome you and we thank you for taking the time out of your day to join us. I'm also excited to introduce you to Steve Galli, our Chief Investment Officer, as our featured speaker. Steve will be taking us through our 2023 financial market review, as well as what's ahead in 2024, offering insights and preparing us for what's next. So we encourage your participation and questions. Please submit them, and we will get to them, as many as we can. And without further ado, I'd like to pass it over to Steve Galli to take it away.
Thank you, Katie, and thank you all for joining us today. Always a pleasure to be speaking with you. Again, we will have Q&A at the end, so hopefully you'll have some questions. Lots to cover today, lots of interesting stuff that happened last year. Maybe more interesting stuff will happen this year. So let's get our disclosures out of the way and kind of get into what we're going to cover. Hopefully I'll keep it to just a little more than a half hour. I'm going to talk about some of the recent headlines that you see in the financial press. We're going to discuss what happened in 2023, then discuss what may or may not happen in 2024. I'm just going to remind everyone about how we approach investments. I think it's always good to make sure that everyone has a good understanding of our investment philosophy and principles. I'm going to discuss a little bit in depth about artificial intelligence, and then, of course, at the end, we'll have questions. So getting into it, I always like to take a look at a lot of the headlines that cross the popular financial press. So this is a recent one from Barron's, which is basically, they have a recent issue had an interview with lots of supposed investment professionals or who were talking about how difficult returns may be to get returns from the markets this year. That's really not that hard to imagine, only because obviously we had a fantastic year in 2023. And anytime you have such great returns in the prior year, sometimes the next year isn't as great. So I thought that was sort of a layup comment there. There's also been a lot of talk about how there is now officially sanctioned exchange-traded funds, or ETFs, that allow the individual investor to access Bitcoin through the ETF vehicle. A couple of very prominent asset managers have rolled that out. Blackstone is one of them. So that remains to be seen whether that'll end up being something that catches on in the market. This one from the Wall Street Journal talking about inflation. This was last week. Americans believe inflation is cooling. Now, why does that matter? Well, a lot of what matters about inflation is people have to, if people think inflation is cooling, that can sometimes be a self-fulfilling prophecy. So it's important that we understand the sentiment of people out there. So I think that was an interesting thing. I personally am not convinced inflation is cooling as much as people think it is, but we can talk more about that. Here's one from Bloomberg, just highlighting the fact that we still are in a very what I would call difficult geopolitical situation globally. Obviously, this headline is talking about what's going on in terms of ships being attacked in the Red Sea. It remains to be seen how much that may escalate, and that, of course, can roil markets, in particular energy markets and oil markets. And then another one from Bloomberg talking about artificial intelligence, better known as AI, in terms of what the dramatic impact that will have on businesses. And, a PricewaterhouseCoopers survey, the subheadline here is that survey said that 45% of chief executive officers say that their companies must adapt or die. That's a pretty dramatic sub-headline there. But the point is, AI is definitely going to be changing a lot of the ways businesses operate, and there's a lot of interest and investment going on there. Okay, so everyone knows I'm kind of a big, movie buff and series buff, and I have always been a huge fan of Star Trek. I guess that means I'm a Trekkie. You name it, I'll talk about Star Trek with anyone, anytime. But I thought it would be fun to talk about a little trivia. When Star Trek first was piloted by NBC, they actually didn't like it. They rejected it. And there was a famous comedian who convinced them to actually reconsider that decision. Does anyone know who that might have been? I find this fascinating. It was actually Lucille Ball who convinced them to give Star Trek another shot. Lucille Ball, of course, famously married to Desi Arnaz. And Desi Arnaz started a production company called Desilu Productions. And by the way, we might have talked about this on another trivia session, but Desi Arnaz was an absolute genius because he began the whole concept of what was known as syndication, when he actually convinced the producers of his show to allow him to keep the film so that he could reuse it later and then rerun it. At the time, no one even understood the concept of a rerun, but that ended up making them millions and millions of dollars. So more about Star Trek. If you're a Star Trek fan like me, you know Leonard Nimoy, the actor here, played Mr. Spock. Mr. Spock was a Vulcan who always was governed by the principle of logic. And it was such a great thing for the Enterprise crew to have Spock on board because he always made really good decisions based upon logic and numbers and information. And as Star Trek evolved into the Next Generation series, that gentleman by the name of the actor was Brett Spiner. He played Lieutenant Commander Data. And what was Data? Well, Data was the next evolution of Spock. He was an android. He basically had a supercomputer for a brain. And what a great person to have next to you on the Enterprise bridge to help you calculate the odds of any given situation that you were facing. So in a way, Star Trek really foreshadowed the advent of artificial intelligence because in many ways, I think if AI evolves the way you think it's evolving, it's kind of going to be like you're going to have a data right next to you to help you make decisions based upon crunching numbers very, very quickly and information. So I think, kudos to Star Trek for sort of being ahead of the curve there. All right. So into 2023, this slide hits on a couple of notable moments. I will say, I think it's fascinating that India is now the most populous country in the world. They actually surpassed China in 2023 as the most populous country. And as many of you know, I think that in terms of emerging markets, in my opinion, India is one of the most important emerging markets to have exposure to. And part of that is due to the explosive population growth and, more importantly, the explosion of their middle class. Lest everyone forget, in March, we did have that bank crisis. Silicon Valley Bank was the largest bank to fail since the global financial crisis back in 2008. We had Fitch downgrade the U.S. credit rating because of kind of the shenanigans going on in Congress about raising or not raising the debt ceiling. And at the end, we had Taylor Swift being named the 2023 Time Magazine Person of the Year. And some people believe that she single-handedly helped our economy really do well in 2023 because people spent so much money going to her concerts and buying tickets and buying all the things associated with going to a concert. So fascinating there. But looking at the markets in 2023, what really happened? Well, we started the year where stocks hit their low for the year on January 5th. And then they just kept on crawling up from there. Bonds, however, actually didn't hit their low for the year until October 19th. And if people recall, the bond market was negative in 2021. It had negative returns, real negative returns in 2022. And at least in modern financial history, there's never been a year where bonds have actually had 3 consecutive years of negative returns. And so in October of last year, people were thinking, oh my gosh, are bonds really going to have another year of negative returns? But lo and behold, in the fourth quarter, bonds actually came roaring back and ended the year in positive territory. So we'll take a little bit more of a look at that. But basically, it didn't matter what you were invested in, you did pretty well. NVIDIA, which is one of the Magnificent Seven stocks, hit over a $1 trillion valuation in May. And that was part of the artificial intelligence hype that was really driving a lot of the market in 2023. So, I'll confess, I did not certainly see that 2023 was going to be as rip-roaring as it was. I don't think anyone did, quite frankly. But it was reasonable to think that we would have a reasonable comeback after such a miserable 2022. But no one really thought we'd have the comeback that we did. And so on this chart right here, I sorted this by the returns, total return in 2023. And you'll see at the top, these are ETF sector returns. So the NASDAQ 100, which is heavily tech weighted, well, that returned over 50% last year. And so it was really all about tech, all about growth stocks. The Russell 1000 growth not far behind. Value didn't do too badly, though. The S&P 500 value up over 22%. And of course, if we look at bond market sectors, high yield bonds, or better known as junk bonds, over a 12% return last year. So high yield was a pretty good place to be. And even munis and government bonds had 4 or 5% returns. So really a solid year all around, pretty much in any asset class you want to name. This is actually, I think, a really good slide for any of those of you out there who are sometimes trepidatious about being in the market. So this chart actually shows what a 60-40 portfolio would be. In other words, about 60% stock, 40% bonds. And as you can see, the overwhelming majority of the time, and this is back, this shows all the way back to 1970, just when I was actually learning to crawl, that we've had positive returns from a nice mixed portfolio, 60% stock, 40% bonds. One of the only 2 years where we had, 15% or worse returns from that type of portfolio, well, one was in 2022, and the other was in the great financial crisis of 2008. But other than that, that type of balanced portfolio almost rarely loses more than 10%, and a majority of the time actually makes more than 10% a year. So this should give someone comfort that the odds are in your favor if you are, in the markets, properly balanced, that you're going to do okay. So this chart, I think, is actually kind of fascinating because this actually this shows all of 2022 and all of 2023. And so, as everyone knows, I'm kind of a bond guy. I love bonds. And in many respects, the equity market does react very much to what's happening in the bond market. So this black line that is flowing through the chart is the yield on the US 10-year Treasury bond. And as you can see, in 2022, the 10-year climbed, and it didn't really stop climbing. It went from a very paltry yield of probably about 1.6%, all the way up past 4% in 2022. When yields climb like that, of course, that was due to the Fed raising rates dramatically in 2022, equity prices suffer. And that's exactly what happened. So, the S&P 500 in 2022, down 25%. But then 2023, what happened? Well, the 10-year note kind of peaked, right? It gyrated around that 3-4% zone. It kind of took off a little bit at the end of 2023 and then dramatically came down again to finish off 2023. And that was when people had a feeling that the Federal Reserve was done raising interest rates. And that sparked a really dramatic bond rally. So in essence, the S&P from the beginning of 2022 all the way to the end of 2023. So basically for 2 years, the S&P return was nothing. So, that's why it takes a lot to recover from a tough year like we had in 2022. And even though 2023 was a great year, all we did really was retrace the losses that we saw in 2022. So I think that's interesting and something to keep in mind. And again, a lot of it had to do with bond market dynamics. All right, so thinking about what's going to happen next year, we have to think about economics and what is going to happen with consumer spending, right? So if we look at this kind of chart shows GDP growth or gross domestic product growth, and essentially, except for this kind of 2 consecutive quarters of negative GDP growth that we saw in early 2022. By the way, that was not declared an official recession. Every recession has seen 2 consecutive quarters of negative GDP growth, but 2 consecutive quarters of negative GDP growth does not define a recession. So basically, we had really good GDP growth in 2023. That was one of the reasons that the market did so well. But as you can see, the forecast for 2024, not so much. And I think part of the reason is many economists, and especially the ones we follow, are predicting that consumer spending is going to slow down. And why is that? Well, mostly because all that pandemic savings that the consumer enjoyed over the last few years is gone. And so the spending power of the consumer is somewhat compromised. Now, that's mitigated by the fact that employment growth is still pretty good. But in general, the general idea for next year, at least according to most economists, is that we will see our economy slow down. And the economy is basically 70% consumer spending. And if the consumer isn't spending as much, that's going to impact the economy. The other thing that really you have to think about for what may happen in 2024, or this year, I should say, is inflation. Inflation has come down dramatically. This actually, the chart on the left shows, the headline inflation numbers since the middle of 2022, and boy, has it come down. But it's kind of getting a little sticky around the 3% zone, and we know that the Fed's target rate is actually 2%. And a lot of that stickiness has to do with the fact that unemployment is still really low. And if unemployment is low, it means people generally are employed if they want to be employed, and ideally are making what they think they deserve to make. And that gives them the ability to spend on things which support prices, right? So it's really a question mark as to how much more inflation is going to come down. The market seems to be pretty optimistic that the inflation will reach that 2% Fed target this year. I'm not so sure about that, but certainly the market seems to think so, and that's one of the reasons we saw a furious rally in the market at the end of 2023. And it would, I'd be remiss if I didn't talk about the Magnificent Seven stocks that really led the way in 2023. And what are the Magnificent Seven? Well, they're actually listed right here. Now, for those of you who do have individual equity portfolios with us, you'll be happy to know that a majority of those stocks were in those portfolios. Apple, Microsoft, Google, Amazon, they always have been sort of, I would call, core bedrock stocks that we've had in our portfolios. So, in 2022, those stocks got destroyed, right? But the returns that they all experienced in 2023 was really nothing short of magnificent, no pun intended. So, Nvidia, which is basically the leading chip maker for really fast processors that are needed for AI applications, well, that stock went up almost 240% in 2023. That's just staggering. Facebook, or Meta, had a dramatic comeback after dropping almost 2/3 in 2022, returned 194% in 2023. And a lot of these stocks were responsible for the overall market's return. And these companies now, you'll see on the right here, they represent a disproportionate amount of the market. Only 7 companies represent about 30% of the entire S&P 500, right? And that's very heavily concentrated. So I think that's a risk. And the risk is that I don't think that concentration is going to stay that way, right? It's very rare that the market has that type of concentration. So I think this next chart is pretty interesting. When you look at this, this is from our friends at Goldman Sachs. This actually shows since 1985, the percent of the largest constituent in the S&P 500. And so back in the mid to late 80s, it was IBM. Then it transitioned to Exxon and General Electric. Boy, what happened to GE? How the mighty have fallen. Then it actually transitioned to Microsoft. Then it went back to energy when oil prices were going gangbusters. And now the largest constituent in the S&P for a long time has been Apple. And at the end of last year, Apple had a 7% weight all by itself. In other words, Apple stock was a 7% component. It represented 7% of the entire S&P 500. That is staggeringly large. But I do think that will offer opportunities for this year, as I think things balance out a little bit and that concentration is not so intense. Now, of course, as everyone knows, I always talk about selling high, buying low. And I also never want to forget to mention that it's important, and I think it's very important for portfolios to have international exposure, especially international equity exposure. And that's because international stocks right now are attractive on a valuation basis, especially compared to US markets. I like to buy things when they're inexpensive, and international stocks are inexpensive relative to the US. I think that should be an important part of portfolios, not too much, obviously, but a reasonable allocation. And that's just because I would expect international stocks, the valuation discrepancy that we're seeing now, to normalize a bit. So I think that's really important. And by the way, international stocks tend to have nicer dividend yields than the US. So even if the market does nothing this year, if you're making a decent dividend yield on your stock, well, you're making something, right? So important for everyone to keep that in mind. And that's one of the reasons why we always want to make sure we do have adequate international diversification. All right, so when we're talking about, our things are expensive, this is one of the charts I always refer to. I think it's really solid. This is where we were about 11 months ago. So this shows where we were in February of 2023. And if everyone remembers, in January, right, the market was at its low point, and then it started taking off. And so in early February, we saw that the valuation was right around 17.5, 18 times earnings. The forward PE ratio was about 18, right? Not dramatically expensive, a little above the average. Certainly not approaching nosebleed territory, right? That's where we were a year ago. And boy, was that a good time to invest. So where are we right now? Well, this is actually as of a couple of days ago. So what this is telling us is that we are now bumping up against what I would consider to be pretty expensive territory. So this is basically telling us that the forward PE ratio of the S&P 500 is right around 19.5, right? The long-term average is about 16.5. So we are getting expensive. So let's talk about this for a second. What does that really mean? Well, it basically means that for every $19 that you invest in the S&P 500, you would get a payout of $1, right? That's pretty much what that PE ratio means. And so what does that mean? Well, that's actually a yield, if you do the math, that's about a 5.3% yield. That's not too bad, right? But if you think about it, if you invest, let's say, in a 10-year treasury bond, which give or take is yielding around 4%, a little less than that, but around 4%. Well, a 10-year treasury bond doesn't really have much risk at all, right? So if you can invest in a 10-year treasury bond and get 4% with almost no risk, but you could invest in the stock market and get a little more than 5%, but take a lot of risk. Obviously, the stock market is a lot more risky than the bond market. Well, that's not so attractive, right? So I actually think that's why I think we need to see things change a bit. So a lot of people ask questions, well, should I invest here? Like, what's going to happen? If we're getting into an expensive territory, maybe we shouldn't be in the market. That's why I always talk about how important earnings are, right? Because it's possible that earnings could come in higher than people expect. Now, this gets into a little bit about, that AI discussion we were talking about. Companies are investing massive quantities of money into AI. And why are they doing that? Well, because they want to make themselves more efficient. They want to improve processes. They want to make their companies quicker and more dynamic. If that investment starts to pay off in 2024 and beyond, then earnings might surprise on the upside. So let's see if I can do some math here. So first of all, how do you get that 19.5 number? Well, right now, the S&P 500 is trading at around 47.65. That's where the S&P is right now. So if I take the S&P level, right, at 47.65, right, and I divide that by what the earnings of the S&P is expected to be next year or in the next 12 months. By the way, that's right now, that estimate for earnings is $245. So that means in aggregate, the companies in the S&P 500 are expected to kick off $245 in earnings. So if I divide where the S&P is trading right now by what the earnings are expected to be in the next 12 months, that actually gets us to this number, 19.4546. So that's how we get there. But if earnings come up, that means that the market can go up and the PE ratio can stay the same. Because remember, it's a ratio. So let's say, for example, that earnings surprise a little bit on the upside. What if earnings came in at 250 bucks? Well, if the PE ratio stays the same, the market can still go up. As a matter of fact, where would the market go if earnings came, assuming the PE ratio stayed the same, where would the market go up? Well, it would go up about 100 points. So let's take a look at the math. If we say 48.50, which is where the market would need to be if we divide that by earnings of $250, because that equals this same number. So the point is, just because the PE ratio is high does not mean the market can't advance, because if earnings come in and surprise to the upside, well, then the S&P can go up, even though the PE ratio or the forward PE ratio won't. So I think it's important to keep that in mind, and that's why I think paying attention to these numbers is really important. All right, so I did mention bonds, though, and I would be remiss if I didn't talk about bonds. So, you know, if you blinked last year in the fourth quarter, you missed a massive bond rally. So I think this is a cool slide because the blue line that I'm mousing over right now shows where the bond market yield curve was at the end of the third quarter, and the kind of orange-yellow line shows where the yield curve ended in 2023. And so this arrow is showing what a massive rally there was in the long end of the curve. 10-year Treasury bonds went from about 4.7 to 4.8%, back down below 4. That's a staggering rally. That's actually why the bond market ended up doing well last year. And so I think that's important, because I think the market started to recognize, hey, if I can get close to a 5% return on almost a risk-free asset, why wouldn't I be buying that if I'm getting something close to that from the equity markets, right? And so we saw a big bond market rally. And so I think it's important for everyone to understand, you know, why do we emphasize bonds sometimes with clients? Well, especially in an environment like this, I think this is an interesting chart, because part of it is it's always about risk and return that you can expect to get, right? So what I call the situation we're looking at with bonds right now is sort of an asymmetrical risk-return scenario. So what do I mean? Well, right now, here we are, or this is where we were at the end of 2023 with the 10-year, right? Or actually, this is the aggregate bond index. So we were at about 4.5%. The aggregate index was about 4.5% at the end of 2023. So the question about bond returns is, well, where can yields go moving forward? They can go up, they can go down, or they might not move, right? So the point of this slide, which I think is really interesting, is that even if yields go up by 1%, and by the way, if yields go up, that's usually bad for bonds, right? It means prices go down. So the point of this slide is that even if yields go up 1%, you know, you're only going to lose about 1.7% or so if you were invested in the aggregate bond market. That's not so terrible. But if yields fell by 1%, you would actually make a return of over 10% on bonds. Because not only do you get the coupon of the bond, in this case 4.5%, but you would get a price return of over 6% if yields drop like that. So if you tell me that, hey, kind of worst case scenario on bonds, I lose maybe 2%, but best case scenario, I make double digits, that's not bad. That's a pretty good outcome, right? And of course, if nothing happens to rates and they stay right where they are, well, you just clip your coupon in your bonds, take your 4.5% and say thanks very much. So I like that type of scenario in bonds, which is one of the reasons I like bonds, especially this year. So I thought I wanted to mention that. Now, of course, that doesn't mean that I don't like stocks. I think it's really important to always be invested in stocks because over the long term, they're going to produce the highest returns over the long term. They always have. But that doesn't mean you shouldn't take advantage of situations in markets when they present themselves like this. Okay, so this is from our friends at Goldman Sachs, and sorry if the print is a little small. I'll try and highlight a couple of things. Goldman Sachs is actually kind of bullish in 2024. They're an investment bank, so of course they're bullish because they want all their clients to do a lot of activity, and clients don't do a lot of activity if people are bearish. But regardless, I think Goldman does a good job of breaking down, some of the things that people might want to think about. They're talking about a consumer slowdown risk as not being as much as people think, because they say that people's household balance sheets are strong, right? People don't have a lot of credit card debt. Mortgage rates are locked in at pretty attractive long-term rates. So they think the consumer is actually on decent footing. They actually think that a deterioration in the job market isn't going to happen either. That's another thing people are talking about. If the unemployment rate ticks up, we might have a problem this year. Goldman doesn't see that. Goldman thinks corporations are in great shape. They think corporate bankruptcies are pretty low, and they think that corporate balance sheets are strong, so not much of a risk there. They think that perhaps the commercial real estate issue that a lot of people have been talking about, meaning commercial real estate is very sensitive to interest rates. And so if you're financing a lot of large buildings and you had great financing several years ago at very low rates, but now you have to refinance at much higher rates, that's a problem. But they actually think that, especially for banks, that office loans only account for about 3% of banks' loan portfolios. And they think banks can manage that. So they think banks are going to be okay. And so there won't be really a contagion effect on some of these issues in the commercial real estate market. And so Goldman is basically in general saying, we don't think 2024 is going to be that risky. Well, how about someone else? This is from our friends at First Trust. Now, First Trust, I like following them. I think their economist is really good. As a matter of fact, they were awarded the most accurate predictive economics team in 2022. Now, they didn't win that in 2023. 2023 was a really tough year to get anything right. But the point is, they usually have some good things to say. So what does First Trust talk about for 2024? Quote unquote, they don't think the economy is out of the woods yet. They actually think we might have a mild recession this year with a negative 0.5% real GDP growth at some point this year. They think that consumer spending is set to slow. Unlike Goldman, they actually think the consumer might be in more trouble. So, interesting to get different perspective there. They also focus a lot on our problematic budget deficit, which has dramatically expanded last year. And they think that's ultimately going to weigh on the markets. And they think it would have been, it would have been even worse if the Supreme Court hadn't struck down the, Biden's loan forgiveness plan. And they're actually thinking inflation might be more sticky than people think. They actually think inflation might be a problem. And so they're actually talking about the S&P finishing the year at 4,500. And what did we just say? We just said the S&P was, I think, around 4765. So they're actually talking about a drop. So always interesting to get different perspectives. I think you got to take everyone's perspective with a grain of salt. And part of our job is to try and digest a lot of what is being said out there to try and figure out, what do we really think is going to happen in 2024? So, the bottom line is, it's actually possible that the Fed has orchestrated a soft landing. Then again, keep in mind that in the last 70 years, the Federal Reserve, right, they've went on 14 tightening cycles. What is a tightening cycle? A tightening cycle is when the Fed raises interest rates, right? They've gone on a tightening cycle 14 times in the last 70 years, and they've induced a recession 12 of those times. So only twice have they avoided causing a recession and pulled off sort of what I would call a soft landing. Odds are not in their favor, right? So, but the market seems to think this might be one of those rare times that happens. So, let's hope the market is right. Certainly the bond market thinks it's wrong because the bond market yield curve is still inverted, and an inverted yield curve means a recession is coming. It just doesn't tell us when. So one thing I think is we're pretty confident about is that interest rates will come down this year. And one of the ways to think about that is, when we look at if we look at the 10-year Treasury bond, what's the real rate of return? By real yield, I mean what you get from the bond itself minus the current rate of inflation. So right now, the real yield is about 1.7, 1.6%. The long-term average real yield, and this is like over the last 40 or 50 years or so, is about 1.3. So that means that either the Treasury bond has to come down a bit, or inflation has to come down a bit, or a combination of both. I actually think maybe a combination of both. So I do think that we're going to see interest rates come down because right now interest rates are in restrictive territory. They are high enough such that it reduces activity, right? The housing market is slow. Why? Mortgage rates are high, right? Business investment and spending is a little slower. Why? Borrowing rates are high, right? That's the control the Fed has. So I do think that interest rates will come down a bit. Maybe not as much as the market thinks, but they will come down. And then again, in terms of equities, well, again, it's all about earnings. Right now, the expectations are for earnings in the next 12 months to go up by about 11%. I actually think that's already priced into the stock market. So the question is, will they surprise on the upside? I'm hoping so. I think that would be a great result, and maybe a lot of this technology investment pays off and starts to pay off. So I do think that that's something to keep an eye on. And as I mentioned, I think that the overall returns of the market will broaden out. I don't think it will just be led by only 7 to 10 companies this year. I think actually that will start to broaden out. And again, I also mentioned, I do think you got to pay attention to international equities because they are much more reasonably valued. So where does all this leave us? Well, at the end of the day, I think it's important for everyone to understand our philosophy, right? So regardless of what's happening in the markets, we always believe that you need to be disciplined. And, I remember when in my first year of business school, all of us were sitting there bright-eyed and bushy-tailed, and our finance professor was looking at us and, saying, all you budding investment bankers, he's like, what really matters in this business? He said, it's the 3 Ds. And so we get our pencils. We're like, what are the 3 Ds? And he said, discipline, discipline, and discipline. He said, that's what matters in financial markets. And I actually have, that's proven, at least in my experience, to be very, very true. You always want to be disciplined in terms of never being overexposed to one area, making sure you're properly diversified. And that goes for, large, mid, and small size stocks, the types of stocks you're in, whether it's sensitive stocks or cyclical stocks or defensive stocks, whether it's US or international, whether it's growth orientation or value orientation. So we think discipline is really important, and that's what we do in our process. And of course, you always have to rethink things. You always have to adjust based upon market conditions. So we are always adjusting every quarter based upon what's happening out there. And by the way, we want to tell you what we're doing. That's why we do what we're doing right now. We want to tell you what we're thinking and why, and adjustments that we're making based upon current market conditions, because I think it's important for you to be informed. This is a really busy slide, but we kind of have 7 key investing principles that we always follow. And I'm not going to go through this in too much detail, but I highlight a couple of things. Of course, it's always about discipline, but the other highlight I have on here is we always look for things that we think are going to be important for long term. We're not about trying to swing for the fences and hit a home run. We want to be consistent, singles, doubles. We want to win long term, and we want to invest in things or themes that we think are important long term. And that gets to sort of AI, right? I think artificial intelligence is going to be an incredibly important theme to be exposed to, not just this year, but for many years to come. So we are going to introduce an artificial intelligence focused portfolio for clients who have the interest and the assets to invest in that. Obviously, that will be a much more risky portfolio because it will be heavily tech oriented and heavy growth oriented, and therefore it will be more volatile. Not for the faint of heart, of course. But again, I think if we talk about AI, why is AI important? Well, because any company that talks on their earnings reports talks about how they're building artificial intelligence capacity. I think AI is mentioned like over 50 times on the average earnings call of S&P 500 companies. And if you think about the way the infrastructure is being built out, what powers a lot of artificial intelligence? Well, it's computer servers. And the artificial intelligence server landscape, the build out of that is really in the early innings. Apparently AI servers, I'm actually sitting near my desktop computer right now, and I can feel the heat coming out of it. AI servers apparently generate 5 times more heat than traditional servers, and they require 10 times more cooling per square foot than traditional servers. That means that the infrastructure investment on these AI server farms is going to be tremendous. Now, I think there's about 8,000 data centers globally, but they're not right now configured for this AI landscape. They're not cooled properly. They're not structured properly to deal with all that heat. That's why there's going to be a lot of investment there. And we think this infrastructure build out is probably going to take at least 4 years. New architecture, new processing units, and also there's going to be a lot of companies that benefit from having a lot of access to data, because you can have all the AI computing capacity in the world, but if you actually don't own the data to feed into that so that you can make sense of that data, well, then it's not so valuable. So we think that owners of proprietary data are going to be really important. So this is why we think you want to have exposure to a theme like this. And one of the reasons why we are focused on making sure that we do have proper exposure for our clients to this very important sector. All right, so I did go a little over than a half hour. I apologize about that. So with that, I will open it up to any questions that we might have.
Thanks, Steve. This was really helpful. If you guys have questions, feel free to put them in the Q&A box, and then I will read them, and Steve will be happy to answer any and all questions that you might have. So with that, here's one to kind of get us started. How do you think 2024 being an election year will impact the markets?
Yeah, we get that question a lot. Oh my gosh, the election year, what's going to happen? Should I be more conservative? The world is going to come to an end if so-and-so gets elected. I'll show you any market study you want to see. Basically, elections, politics don't matter. Doesn't matter whether our administration is Republican, doesn't matter whether it's Democratic, the stock market doesn't care. Now, the stock market does react to some important legislation, most importantly, tax policy, right? And obviously, the administration in control has influence over that. But in general, the market really is apolitical. It's an apolitical animal that doesn't necessarily correlate to specific election outcomes. So in general, we try and counsel everyone to not really worry about it and just stay the course, and let everyone talk about what's happening with the election, even though it's really ultimately not going to determine what happens in the markets.
Thank you. That's really helpful. Well, I don't see that we have any other questions. I'll run through a couple of housekeeping things, and then once I'm done with those, we'll see if we have more. So we do have another webinar coming up that Steve is going to host on February 15th. Again, it's at noon Eastern, and that one, he's going to cover a bit more about the near term pertaining to this quarter. So we're going to send an invite out for that one pretty soon. So be on the lookout for that in your email. And then also when this webinar ends, you'll see a quick survey that will pop up in your browser. And so with that, we're finalizing our 2024 webinar schedule, and we'd love your input on topics and improvements overall. I think your feedback is really key to making these sessions as helpful as possible. So we're excited to see what you want to learn about. All right.
Yes,
So
thank you, Alana, and I would encourage you to answer that survey. We always want to hear from you. And I just saw a question come off the tape. What do you recommend to people who are close to retirement but not diversified enough, or perhaps concentrated in one or two big stock positions? You know, how do you fix that going forward when you might incur a large tax burden? That's a great question. We do have some clients who are fortunate enough to have potentially invested in, let's say, a Apple or a Microsoft, and have seen it that their position grow exponentially over the last 10 or 20 years, and are now sitting on a position that has a massive built-in gain, right? So we do offer what I will call different strategies to try and mitigate the risk around having what I would call a very high concentration risk. Because, you know, as anyone knows, you know, when certain companies, especially in the tech sector, can sometimes get a lot of negative attention. And so, you know, if Congress all of a sudden says, you know what, let's break up Amazon, or let's, you know, put the clamp down on Google, that can have a big impact if you happen to be an owner, a big owner of that one particular stock. So, and some of the strategies we offer are what I would call, you know, option strategies, meaning where we can kind of protect your position a bit on the downside and slowly try and get you out of it over time by selling some off. So we do have some options for clients in that position. I encourage you to talk to us or your advisor with us in more detail about that, because I do think that's something that is important to address to mitigate that risk that you'd be facing. And, you know, because I think, as I said, I think discipline is important. It's always important to be diversified. And if you're not diversified, you know, the risks of a bad market hurting you increase. So good question there. I think someone else had a question that came through about, you know, what is the effect on the markets based upon the approval of the Bitcoin going into an ETF. You know, funny, the Bitcoin hasn't really rallied much since that happened. I think part of the Bitcoin rally that has occurred happened as an anticipation of that approval. And it's not 100% clear to me what's going to play out as a result of, you know, there being exchange traded funds that allow people to access crypto. I will caution everyone once again, you know, crypto has no inherent value at all. The only value is what someone else is willing to pay for it, right? But that being said, it does offer an interesting diversification play as long as you're willing to just, you know, realize it should only be a small part of your diversification. But I will say one more thing, which is, in my opinion, if you do want to own cryptocurrency, I'm not advocating that you do, but if it is something you want to have maybe a little exposure to, I actually think you should just buy it directly. I don't think you need to go through another investment vehicle to own it, or in other words, own it through a derivative, right? Because if you own it through an ETF, it's really a derivative of it. So I actually think, you know, you really want it, just buy it directly. That's something to, you know, something to consider for those who aren't faint of heart. But in general, I think exposure to that type of asset class should be very, very small, and only for people who are already well diversified in all the other classes.
I think that's all of our questions, Steve.
Great. Well, I hope everyone has a great rest of their day and has a great rest of their week. And until next time, and we look forward to hearing from you on that survey.